You know what's wild? Most people are still overpaying for car insurance just because it's a pain to switch. That's why there's Jerry. Jerry is the only app that compares rates from over 50 insurers in minutes and helps you switch fast with no spam calls or hidden fees. Drivers who save with Jerry could save over $1,300 a year. Before you renew your car insurance policy, do yourself a favor. Download the Jerry app or head to jerry.ai/acast.
Running a business can be exhausting. Building your website shouldn't be. With Wix, you can express your ideas, give direction, then leave the heavy lifting to AI, from site creation to branded content and images. Have fun with the details. Customize what you want the way you want, and manage your whole business from a centralized dashboard with expert AI tools. Build, scale, and enjoy the incredible results. You can do it all yourself on Wix.
Good morning, and welcome to the General Motors Company second quarter 2025 earnings conference call. During the opening remarks, all participants will be in a listen-only mode. I would now like to turn the call over to Ashish Kohli, GM's Vice President of Investor Relations.
On today's call, management will make forward-looking statements about our expectations. These statements are subject to risks and uncertainties that could cause actual results to differ materially. These risks and uncertainties include the factors identified in our filings with the SEC. Please review the safe harbor statement on the first page of our presentation, as the content of our call will be governed by this language.
Hello, everyone, and welcome to Kilowatt, a podcast about electric vehicles, renewable energy, autonomous driving, and much, much more. My name is Bodie, and I am your host, and you might be able to tell that I am losing my voice because I'm sick. So today, as you might have guessed, we're going to talk about GM's Q2 2025 earnings call. Let's go ahead so that I can save my voice and just jump into Mary Barra's opening remarks. By the way, this whole thing is edited down to talk about just stuff that we talk about on this show. If you want to listen to the whole entire earnings call, I would encourage you to go do so. Although I don't think I colored any of the information one way or the other. Always go do your own due diligence. All right, let's listen in on Mary's opening remarks.
We are growing in EVs because we have a strategic portfolio of vehicles that people love for their design, performance, range, and value. 5 years ago, the EV market essentially had one player. Today, there are 30, and Chevrolet is now the number 2 EV brand thanks to the success of the Blazer EV and the Equinox EV. And in Q2, Cadillac became the number 5 EV brand overall. Cadillac has also become the luxury EV leader, fueled by the launch of the Escalade IQ and conquest rates that are above 75% for the Lyriq and approaching 80% for the Optiq. At the same time, all-electric road trips are getting easier by the day thanks to our fast-charging collaborations, which have been focused on regional interstate corridors outside of the coast. For example, GM Energy 350 kilowatt chargers are now available at nearly 200 pilot travel centers along I-75 between Michigan and Florida, on the routes between Minneapolis and Milwaukee, Detroit and Cleveland, San Antonio and Houston, and Dallas and Nashville. Stations are typically no more than 150 miles apart, so it's easy to take long-distance trips knowing you'll have access to reliable fast chargers and convenient services when you need them. In addition, the first of Iona's charging stations, which can deliver up to 400 kilowatts, are now in service in North Carolina, Texas, Pennsylvania, Ohio, Kansas, Arizona, and Missouri. By the end of the year, our customers will have access to more than 65,000 public fast-charging bays across the country. That will grow to more than 80,000 by the end of next year and 100,000 by the end of 2027, a more than 50% improvement in just 3 years.
You know, when Mary was talking about the charging network, it's really important, or really highlights the importance of partnerships. You know, it's great that Tesla built its own network, and it's great that Rivian's largely building its own network, but we need to have partnerships. We can't just have every single every single automotive company just can't have their own charging network. That doesn't work. So this is partnerships done right. All right, let's move on to the next clip.
The growth of our ICE and EV business is also fueling the expansion of our highly acclaimed Super Cruise technology, which in turn is helping guide the development of our personal autonomous vehicles. We're making steady progress growing Super Cruise. The technology is now offered on 23 models, and we continue to add new capabilities. We're on track to have more than 600,000 customers by year end, each of whom has paid upfront for 3 years of service, with 70% of new Cadillacs delivered equipped with Super Cruise. Our projected Super Cruise revenue will be more than $200 million in 2025 and is expected to more than double in 2026. As we continue to scale, we anticipate growing at a robust double-digit CAGR through the end of the decade.
When she says that they're going to have 600,000 and most of those are paid up front for the first 3 years, I wonder if that comes with the purchase of the car. I know in some cases it does, maybe not in every single case. So I think that's a little bit of a, if it does come with the purchase of the car, that's not much of a celebration. I mean, yeah, absolutely, you can count those as users of the technology, but in reality, these people didn't opt in for it. It was just given to them. It'll be really interesting to see where it is in 3 years. Now, if people did opt in, buyers did opt in for this, then I think that's a little bit more of a tell that people are optimistic about GM's Super Cruise. Tesla does not release full self-driving purchase and subscription numbers. So it's kind of hard to do an apples to apples comparison. But I would imagine that if Tesla had really good numbers, they would tell us what those really good numbers were. All right, let's move on to our next clip.
Despite slower EV industry growth, we believe the long-term future is profitable electric vehicle production, and this continues to be our North Star. As we adjust to changing demand, we will prioritize our customers, brands, and a flexible manufacturing footprint, as well as leveraging battery investments and other profit improvement plans. The battery strategy we are executing is central to our efforts to make EVs profitable and an even better choice for our customers. Domestically developed and produced cells are also necessary for a resilient and secure American-oriented supply chain. Our joint venture cell plant in Indiana, for example, will produce prismatic cells to help lower pack and total vehicle cost. Foundation work is almost done, and more than 50% of the steel structure has been erected. We have also confirmed that Ultium Cells Spring Hill in Tennessee will begin producing LFP cells developed by our Korean partner LGES, in addition to high-nickel pouch cells starting in late 2027. The new lithium manganese-rich, or LMR, chemistry that we are developing with LGES will be another game-changer because of its unique balance of energy density, charging capability, and cost efficiency driven by its reduced nickel and cobalt content. In large truck packs, we believe the potential savings from LMR may be even greater than using LFP at today's metal prices. Our expertise in leading cell chemistries and formats is also creating new business opportunities. Today, GM's Second Life EV batteries are being repurposed by Redwood Materials. In addition, we're finalizing an agreement with Redwood to supply battery modules to Redwood Energy, their new energy storage business, which has been formed to meet surging power demand for AI data centers and other applications. Importantly, all of the cells our JVs build have and will continue to qualify for the Advanced Technology Manufacturing Tax Credits, and we're grateful for the continued support of the administration and Congress as we invest in American battery innovation and job creation.
You know, this is interesting because the next clip, we're going to hear about tariffs and how it's affecting GM. And we'll kind of hear that throughout the earnings call. There was a lot of tariff questions. There's a lot of tariff questions in the Ford earnings call as well. And I think, what is today, August 2nd? There's still a lot of unknowns about tariffs, and we'll kind of see where this goes over time. But I think that GM is setting itself up for success with the diversity in technologies that they're using for the batteries and bringing that, to home shores. So it's not as affected by the tariffs. Okay, let's get to the next clip, which is about tariffs. By the way, the guy talking is Paul Jacobson, the Chief Financial Officer for GM. All right, now let's get to the clip.
Adjusted automotive free cash flow was $2.8 billion, down $2.5 billion year over year. The decline was primarily driven by tariff payments as well as headwinds from working capital and lower dealer inventory levels. In North America, we delivered EBIT adjusted of $2.4 billion and EBIT adjusted margins of 6.1%. Excluding the impact of tariffs, our margin would have been approximately 9%, which underscores the fundamental strength of our business. On a comparative basis, this keeps us well within our pre-tariff margin target of 8 to 10%. In addition to the impact of tariffs, warranty expenses have also been obscuring our strong performance, including a $300 million increase in the second quarter compared to last year. The main factors behind the higher warranty expenses relate to L87 issues and higher warranty claims from software issues on some of our early EV launches. Let me be clear. We are not happy with our warranty trend and are facing these challenges head-on, with the top priority always being our customers. We've provided extended warranties in some instances and taken other proactive steps to support those affected, including shifting some supply of our components to our after-sales group to decrease repair times. To address the root causes, we are pursuing multiple paths. We are working to improve supplier quality across the board and are engaging more on critical component operations than ever before to ensure they consistently meet our high standards. Spending on a per-vehicle basis for software-related issues is down roughly 25% year over year when comparing most recently built vehicles to last year's models. Our expanded use of over-the-air updates, lower number of incidents per vehicle, and increased robustness in our infotainment system updates are all contributing to this improvement. Additionally, we are leveraging our enhanced diagnostics and developing new prognostic tools to identify issues sooner, develop repair procedures faster, and minimize unnecessary repairs.
Okay, so those software glitches that he was talking about, or issues, those were in late 2023, like December 2023, January 2024, and most of those issues were with the new Blazer that was rolling out. It sounds like they've got a handle on that. However, it definitely took its toll on the company. And as a result of the bad software, the Blazer, which reviews very well now, actually got very poor reviews in the beginning because of the issues with the software. All right, let's go ahead and move on to our next clip, which now we're in the realm of analyst questions. So I don't know who's asking this first question, but it's about tariffs.
And just as it relates to tariffs, you're taking, as the world sits today, and you're talking about the input, $4 to $5 billion, the mitigation. What would be the best case scenario? We get a settlement with U.S., Canada, Mexico, Korea. What would the impact look like right now, like for this year, if the world changed tomorrow and it went back the other way? And then what do you have strategically that helps you from a performance standpoint as you go forward with the $4 billion investment?
Yeah, Michael, it really, I mean, obviously our tariff impact would be lower if the tariffs with Mexico, Canada, and Korea were lower. So, that would have an immediate impact. You have to look at how much lower it's going to be to know what the total impact there would be.
Right.
But, that would have a immediate, because as Paul said earlier today, we have continued to bring the vehicles in from Korea because they're contribution margin positive and they're in very much in demand. I mean, customers love those vehicles. We've made some short-term shifts of production into our U.S. footprint. I think what's going to happen, though, as we've always said, we feel we'll be able to offset 30%. A lot of that will come in later this year, as well as we'll continue to make improvements across the board as we get into next year. And 18 months from now, the capacity, the $4 billion that we talked about, that capacity will come online, and then that will have another step function improvement. And in some cases, the capacity we're adding is also for unmet demand. So it's a win-win from that perspective. So, we're on I think a positive trajectory as we look into later this year, into next year, and clearly into 27 will be substantially better. And, to your original question, when we see what the final agreements are between these key countries for us, then we'll be able to size that as well.
So you're prepared for the worst case scenario. So there's potential for some upside the way we look at it.
I think that's a fair comment. I don't want to predict what worst case is,
Right.
but I think with what we know today, I think that's what we've used. So I think there's potential.
Yeah, I don't think anybody can predict what's going to happen. So thank you very much.
Thank you.
Thanks, Mike.
All right. I have nothing to add to this clip because I agree. It's very difficult to predict what's going to happen. So let's move on to our next clip, which is about EV strategy.
The second question is just about the EV strategy going forward, and appreciate the commentary about you want to give consumers choice, but now that the tax credit is on its way out and there's changes in the regulatory schemes, I know we've seen a broad lineup across price points, but the profitability has been challenged, and I think these changes indicate profitability is probably going to get a little trickier. So, especially given you're losing some of the scale benefits, which was supposed to drive profit. So, how do we look at the depth or the breadth of your EV lineup going forward and the price points at which you're offering vehicles when it seems like it's just going to be much tougher to get profitability at the more lower price points? Is it that we just see higher price points and that's the strategy?
Well, I think we have a very strategic EV portfolio when you look at luxury trucks and then the affordable vehicles like the Blazer and the Equinox EVs. And so we think we're covering the market very well. Before we even had IRA and the $7,500 tax credit and some of the other portions of that, there still was demand for EVs. And we think as charging grows, and that's one of the things we highlighted because we are continuing very capital efficiently through partnerships to make sure we continue to expand the EV charging network. I also think there's an opportunity for EVs for those that have a two-car family that have a garage that they can charge. It makes a lot of sense to have that one of those two vehicles be an EV. So I think as we get through this period and we go through the potential pull ahead and before the September 1st, where the consumer tax credit goes away, then we get to fourth quarter, we'll probably see a little result of that pull ahead. We get into 26, and I think we'll start to understand what real EV demand is. What we have been saying is what we're investing going forward is largely focused on improving our EV profitability. The announcements we've made from a battery perspective with LMR and LFP, some of the work that we're doing as we move forward to have lighter architectures, more aerodynamic that allow us to use a smaller battery. So we're very focused in this period of time to drive, not just get to variable profitability, but get to profitability and then, to continue to improve. So we have, appropriate and strong margins from our EVs as well. And then we're very well positioned in the market for later in this decade into next decade. And we truly offer consumers choice. So we think we've got the foundation with the EV platform that we have that allows us to go, from a very small vehicle all the way up to a super truck like the Hummer. We think that's an advantage for us. We think there is going to be an EV market that will grow over time, albeit it'll start lower and potentially grow more slowly. But we're well positioned to do that. And, right now we're seeing growth in both ICE and EV from a share perspective with, as Paul mentioned, very disciplined incentives.
And there's a clear path to grow to get to profitability on the affordable EVs?
I'm sorry, I didn't hear the beginning of your question, Dan.
There's a clear path to get to profitability on the affordable EVs?
Well, that is what we're working on from all aspects, and definitely the battery technology changes. And as we grow with affordable, which is in the heart of the market, that gets us the scale benefits as well. So we are focused on each and every vehicle getting to profitability, and we're not going to stop until they do.
GM, and to a certain extent Ford, has really positioned himself, and I guess we can add Stellantis to this if you count Europe and not so much the U.S., but they have positioned themselves in a spot where when EVs are hot, they sell EVs. When EV sales go down, who knows what's going to happen when the $7,500 federal tax credit goes away here in the U.S. When those sales go down, or if they go down, people are going to buy ICE cars. Guess who has ICE cars? GM, Stellantis, and Ford. Guess who doesn't? Tesla, Rivian, and Lucid, although I wouldn't put Lucid anywhere. They haven't officially announced their $50,000 vehicle yet. At least Rivian's coming out with something more affordable next year, but their prices are just so far outside of what normal humans can afford. Although I do know somebody that recently got a Lucid, and I am very jealous of their purchase. I'm very jealous of you, Tom. All right, let's go ahead and move on to our next clip.
Great, thank you.
Not a problem.
Thank you.
That thank you felt passive aggressive. Anyway, here's the next clip.
Our next question comes from Ryan Brinkman with JP Morgan. Your line is open.
Tired of your car insurance rate going up even with a clean driving record? You're not alone. That's why there's Jerry, your proactive insurance assistant. Jerry compares rates side by side from over 50 top insurers and helps you switch with ease. Jerry even tracks market rates and alerts you when it's best to shop. No spam calls, no hidden fees. Drivers who save with Jerry could save over $1,300 a year. Switch with confidence, download the Jerry app, or visit jerry.ai/ACAST today.
No offense, but your brain is a terrible place to keep your big idea. It belongs in the world, but you know that already. You have a calling, a voice that says, this is what I'm meant to do. Create the website your big idea deserves with Wix. Make it your own with top-to-bottom customization, AI to help realize your vision, and built-in business tools to turn your daydream into your dream job. Wix supports every stage of the business journey except one. Your decision to begin. Ready? Go to Wix.com.
Dad, te tengo una buena noticia. Si nos cambiamos a Verizon, nos dan 4 líneas por el precio de 3.
¿De verdad? Es como si la cuarta línea fuera gratis. Ok, una para mí, otra para tu mamá, una para ti y la cuarta para...
Para mi novio.
Excuse me?
Dad, mira, quiero estar en contacto con él todo el tiempo, hasta en las vacaciones.
Pero vamos a estar fuera del país.
No importa. Cuando viajas con Verizon, tu teléfono también lo hace. Imagínate, puedes hacer llamadas, textear, así yo estoy contenta.
Y yo también.
Que empiecen las vacaciones y los ahorros con My Plan de Verizon. Cámbiate hoy y llévate una cuarta línea para quien tú quieras por el precio de 3 por solo $30 por línea al mes en Unlimited Welcome y AutoPay más impuestos y cargos. Además, usa tu teléfono en el extranjero con Travel Pass en un país que elijas 3 días al mes por $10 al agregarlo a My Plan. Visita tu tienda Verizon en DC. En el plan Unlimited Welcome, los datos Unlimited 5G, 4G LTE podrían ser temporalmente más lentos que los de otro tráfico durante una congestión. Roaming de datos nacional a velocidades 2G. Se requiere tener una línea suscrita a My Plan para los 3 días de Travel Pass. Se aplican términos adicionales.
On WhatsApp, no one can see or hear your personal messages, whether it's a voice call, message, or sending a password. To WhatsApp, it's all just this. So whether you're sharing the streaming password in the family chat or trading those late-night voice messages that could basically become a podcast, your personal messages stay between you, your friends, and your family. No one else, not even us. WhatsApp. Message privately.
Great. Thanks for taking my question. I wanted to ask on the impact of tariffs on your earnings power as we move beyond this year. Earlier you'd called out $4 to $5 billion of tariff impact over the course of 2Q through 4Q 25, so annualizing to maybe 5.3 to 6.7 billion, with the goal of mitigating at least 30% of the impact this year. But that was before the various investments in U.S. manufacturing announced during the quarter. How should we think about these footprint actions impacting net tariff costs going forward? What degree of tariff cost mitigation beyond the 30% target for this year do you think you might be able to accomplish after these investments come online in 18 months' time?
Yeah, good morning, Ryan. I'll take that one. Thanks for the question. We have we highlighted that of the $4 to $5 billion, about $2 billion of it is Korea, and as Mary mentioned in her comments and in a recent question, that obviously the trade deals with Mexico, Canada, and Korea are going to be important. We're not speculating on what those are going to look like going forward, but there is there's a possibility and a likelihood, if you will, that ultimately a tariff rate gets set at a lower level, which would ultimately bring that impact down. As far as the other aspects of the tariffs, we talked about the $4 billion, which will bring us, when all that is implemented, to producing over 2 million vehicles here in the U.S. That will take care of a large part of the other remaining tariffs that are out there. We're still working through supply chain and other indirect tariffs, but we're not speculating on what it'll be. But I expect that it is likely lower than the current run rate of what you would see just as things shake out. Remember, we're only 90 days into this. As to the 30%, I mean, these are shifts in sort of the general operation of the business that we don't necessarily think go away if tariffs are reduced. So I think we've got a longer term plan to be able to mitigate a substantial part of this. We're obviously looking for things to normalize around these trade deals that will get done, and we expect that'll happen. But it's too soon to extrapolate that as a run rate into the future.
I told you there's a lot of tariff questions, but there's not a lot of good tariff answers. Like that was a pretty vague response. It's not to say that everything that he said was not, and beneficial in some way. And it's not his fault. Like the last thing you want to do is make the administration mad. That's probably not a thing that you want to do. So in some ways, I understand why they're hesitant to plant a flag. In other ways, I completely understand. Like there's still so many unknowns, and this is, Liberation Day was in April. So that's when Trump announced all of the tariffs, and now we are in August, and it's kind of hard for, consumers to navigate what's going to cost more, what's going to cost less, and keep track, by the way, because everything is fluctuating. I don't know how you keep track what goes up and what goes down unless you buy it a lot. But it's got to be, an order of magnitude or several orders of magnitude harder for these companies. All right, let's move on to our next clip.
Thank you. Our next question comes from Joe Speck with UBS. Your line is open.
Thanks. Good morning. Paul, just maybe turning back to some of the tariff comments, and I understand, a lot has changed, but you did mention that you expected the biggest headwind to be in the second quarter, and now it seems like the third quarter. So maybe you could just sort of help us understand what, large buckets, what sort of changed within that. It seems like in the slide you're mentioning indirect tariffs, which is maybe commodities, and or maybe there's something with the mitigation efforts. Just any color you have there.
Yeah, thanks, Joe. You got it. It's really on a lot of the indirect items that when we came out with the overall tariff guidance, we were estimating the timing on when some of that would hit. So I would expect that we would have more expense potentially in the third quarter, but we're still tracking on that 4 to 5 despite all the changes that we've seen going forward. So it might be slightly higher in the third quarter, and that's kind of what we're thinking right now. On the cash side, we actually expect that cash impact potentially to be lower. We're still, didn't get the full benefit of the MSRP offset just because of the timing. So that'll materialize in the second half of the year on the cash side. But from an expense side, just think slightly higher in 3Q, but still on track for the $4 to $5 billion for the year.
Okay, so I don't have anything to add to that. So let's go ahead and jump into our next clip.
Turning back to EVs and regulatory policy, but maybe from a little bit of a different angle. I know in your K you disclosed that last year you expensed $1 billion for credits. Was wondering if you could let us. It doesn't sound like you expect much sort of change to this year, but I was wondering if you could let us know how much you are counting on that expense to be this year, and is it fair to assume you have a potential, if we're comparing 26 to 24, you have a potential $1 billion tailwind from credits?
Yeah, Joe, it gets really complicated really fast, as you might imagine, with the different regulatory schemes. But what's in there is CAFE, GHG, state regulations, et cetera. So what we know today is, the CAFE penalties under the One Big Beautiful Bill were zeroed out. So we did have some balance sheet purchased credits that were there this year, but we also have some expenses that already booked. That's going to basically be a wash for us, so I don't expect any material adjustments from CAFE. GHG obviously has not been fully answered. We have comments from the administration, and in the one big beautiful bill, there are changes to future compliance, but we're still working through that across the board. So I think 25 is a little bit of a transition year as we understand what the future landscape is going to be, and how that's going to affect the credits and the liabilities that are on the balance sheet this year. But going forward, we do expect to be a more, I guess, a lower expense rate for compliance in the future.
I would add to that, it also gives us the opportunity to sell EV vehicles, ICE vehicles for longer, and or appreciate the profitability of those vehicles while we're, month by month, quarter by quarter, year by year, improving our EV profitability. So I think it's a huge opportunity.
Okay, so I just want to add, GHG is greenhouse gases, and then CAFE is, it's corporate average fuel economy standards. All of those, I don't think they went away. I just think the penalties for those went to zero, from how I understand this. Now, I do have some research that I'll be doing this week to see try to understand it a little bit better. And who knows, the stuff, I'll be honest with you, is so confusing. I may or may not have answers for you next week, but I wanted to look into it a little bit more. But basically, there's these standards that they have to follow, but there's no penalty if they don't follow the standard, is how I understand it. All right, let's see. We have 2 more clips. Let's go ahead and jump to our next one. Oh, and by the way, I did not have this question on my bingo card. Totally took me by surprise. I actually sat up and started listening more intently when this question was asked by Adam Jonas.
Thank you. Our next question comes from Adam Jonas with Morgan Stanley. Your line is open.
Thanks, everybody. And Mary, about 15 or 20 years ago, GM was leading the industry in humanoid robot development, working together with NASA on Robonaut 1 and then Robonaut 2, deploying an upper body humanoid on the International Space Station in 2011. Fast forward to today, and most of your key competitors have a humanoid program. And many, myself included, think that this market's 10 times larger than cars at least. So when can investors learn more about GM's robotics chops and your in-house robot facilities? Mary, as an engineer, I'm sure you must be super excited about the opportunity to show investors where GM can dominate here. And Mary, I actually think that this is good for the UAW because we need American human muscle to develop, build, and service these robots. So when are we going to learn more?
Well, Adam, thanks. I actually didn't work directly on that project, but it was in the area I was responsible for. So I know the NASA partnership you're talking about very well. Also, we have a very long and rich history with GM Robotics, GM Fanuc, sorry. And we still have a very, very strong partnership. So we have a core capability in the company for sure. There's also partnerships that we're looking at and strategic relations that we have. But as we look at automation overall, our first look as we want to not only lead from what happens from a robotics perspective, because remember, a lot of things that we leverage robotics for are areas where there's safety challenges to do the work. If there's ergo challenges, we have a very robust ergonomics program in this company to make sure people don't get hurt doing their jobs. And then just difficult or very, dirty tasks that, frankly, no one wants to do, and I don't blame them. And so there's a lot to do there. There's also work to do to get rid of a lot of the indirect. But we've also done a lot of work from a winning with simplicity perspective, and we've talked about that for the last few years. But first has been focused on what was, I'll say, some of the low-hanging fruit to simplify how we go to market from a trip level perspective, free flow options, et cetera. But now we're really getting into part design where the parts are just simpler parts or a part that integrates and does more functions. So there's tremendous work going on across the company to lead to manufacturing efficiency. And then, like I said, as we go forward, we're going to continue to capitalize on the core knowledge that we have in this company to make sure we're driving efficiency. I'm also very proud of the fact that, way back when assembly lines and all the equipment in a plant was controlled by wires and relays, we did training programs partnering with the local community colleges to train our workforce to be able to leverage how we run automation today. From a computer perspective, we have an active training program that right now where we're training more and more electricians and technicians as we have more complexity in our plants. And so we're going to continue to do that, something I'm very proud of. And I do agree there's huge opportunity for our workforce as we look to what technology has to offer to improve the jobs. But overall, we're focused on what's going to drive manufacturing optimization across all elements.
That's great, Mary. That sounds like stay tuned, and bless you for investing in those important areas in our country.
I wonder, it kind of sounded like if they were going to do robots, it would be mainly for manufacturing. I need a robot for my house. I need, and Elon has said that the Optimus is going to be able to do things around your house. I need that. But I do agree that certain jobs are more dangerous than others, and certain jobs are dirtier than others. And as a person who works in an industry with a high level of cancer and also, heart disease and things like that, I'm all for helping people out to help them so that they can live longer and enjoy their pension.
Tired of your car insurance rate going up even with a clean driving record? You're not alone. That's why there's Jerry, your proactive insurance assistant. Jerry compares rates side by side from over 50 top insurers and helps you switch with ease. Jerry even tracks market rates and alerts you when it's best to shop. No spam calls, no hidden fees. Drivers who save with Jerry could save over $1,300 a year. Switch with confidence, download the Jerry app, or visit jerry.ai/ACAST today.
Dad, te tengo una buena noticia. Si nos cambiamos a Verizon, nos dan 4 líneas por el precio de 3.
¿De verdad? Es como si la cuarta línea fuera gratis. Ok, una para mí, otra para tu mamá, una para ti y la cuarta para...
¿Para mi novio?
Excuse me?
Dad, mira, quiero estar en contacto con él todo el tiempo, hasta en las vacaciones.
Pero vamos a estar fuera del país.
No importa. Cuando viajas con Verizon, tu teléfono también lo hace. Imagínate, puedes hacer llamadas, textear, así yo estoy contenta.
Y yo también.
Que empiecen las vacaciones y los ahorros con My Plan de Verizon. Cámbiate hoy y llévate una cuarta línea para quien tú quieras por el precio de 3 por solo $30 por línea al mes en Unlimited Welcome y AutoPay más impuestos y cargos. Además, usa tu teléfono en el extranjero con Travel Pass en un país que elijas 3 días al mes por $10 al agregarlo a My Plan. Visita tu tienda Verizon en DC. En el plan Unlimited Welcome, los datos Unlimited 5G y 4G LTE podrían ser temporalmente más lentos que los de otro tráfico durante una congestión. Roaming de datos nacional a velocidades 2G. Se requiere tener una línea suscrita a My Plan para los 3 días de Travel Pass. Se aplican términos adicionales.
All right, this is our last question, and it's a follow-up from Adam Jonas. Let's go ahead and listen in.
Just a follow-up on EV profitability. I want to return to that. Tesla is still seen as the benchmark in Western EVs by many. Maybe you're now the new benchmark or the new emerging benchmark, but in Western EVs, they're still the big dog. But if you remove ZEV credits, which is probably appropriate, and downstream retail, they're loss-making. I mean, they're worse than Renault. Their margins are worse than Stellantis. They would really love to have your GMI margins. So add this to Elon seems to be also exiting the auto industry, clearly pulling capital out of the business and doubling down on AI and autonomy and robotaxi. So how does GM expect to be profitable with EVs when players like Tesla are apparently cannot? I'm just wondering what you'd highlight as your differentiation in terms of how you configure the vehicles or your scale or something about working with the Koreans and your in-house work. Something when you benchmark Tesla, why are they loss making and you feel that you can be profitable? Thanks.
Well, I think, one of the things I'm very proud of, I'm not going to comment on Tesla because there's a lot there. And as you know, I don't usually comment on competitors, but I think when I look specifically at General Motors, one of the reasons our EVs are doing so well from a customer perspective is they're true to our brands, whether it's Chevrolet, whether it's Cadillac, whether it's GMC Hummer and GMC. Also, beautifully designed vehicles that have the range and the performance that customers are looking for, whether you're talking about a truck or all the technology and safety we put into an Equinox. That's what we're known for, and the beautiful design with also efficiency. As Paul said in his opening remarks, we still believe we have tremendous opportunity to, as we did our first EV platform, to make changes to that to drive more efficiency from a weight perspective, from a simplification perspective. The same is true for batteries, and we're investing in future technologies that are going to allow us to take significant cost out, and then we will get scale. And one of the things I'm really excited about with how we have been growing our share quarter after quarter is the support that we have from our dealers who now really understand EVs. They understand what the customer's looking for. Like I said, I think we can improve that scale when we think about two car families that have an opportunity to have one of those vehicles in the garage be EV even before the charging infrastructure is there. So it's going to be beautifully designed products with brands people trust. Remember, we have the highest loyalty. It's going to be having the right technology on the vehicle, getting that scale, and then the engineering solution. So I'm very bullish on where we're going to be on EVs as we continue to move forward in the next couple of years.
And Adam, I'll just add too. I think the other asset that we have is, a lot is made about Tesla's simplicity and their scale, and clearly, within a couple of narrow segments, they do have that, and they've realized some good advantages. And hats off to them. It also leaves them overexposed to, a demand set that has been highly volatile. When you look at what we've done in Spring Hill and what we've announced that we're going to do in Fairfax, we're increasingly building flexibility into our operation, into our manufacturing plants, that as we go through this period of transition, however long it might be, where customers are adopting EVs at a slower or a faster rate, that is going to change year to year, for the foreseeable future. That built-in flexibility for us to switch between EV and ICE and make sure that we meet customers where they are is an inherent advantage that we have, because we can absorb some of the costs of that manufacturing facility with more ICE production if EV demand goes down. So that flexibility is going to be important for us as we go through the next several years, and I think is going to be helpful on that journey.
All right. I think that sums it up nicely. And I'm all for more electric vehicles in the world and less ICE cars in the world. But from a purely business standpoint, if one of those two platforms is less popular, a company like GM, Ford, and Stellantis, and I think I said this earlier, they have those other cars to fall back on. If EVs are unpopular, there's ICE cars. If ICE cars are unpopular, there's EV cars. If both of them are unpopular, there's hybrids. Tesla doesn't have that. And I'm not, I don't think that's a bad thing necessarily from an ideological standpoint, but from a business standpoint, it might be a little bit more difficult. But I think EVs are here to stay, and I think the transition is inevitable. All right, we are going to end this podcast with Mary Barra's closing remarks.
Thank you. I'd now like to turn the call over to Mary Barra for her closing comments.
Well, thank you. And I want to thank everybody for your attention and for your questions. We really do appreciate the dialogue, but I hope you step back and see that we are well positioned for the future. We have a lot of momentum with customers as we adapt to the changing markets, trade and tax policy, and we are demonstrating leadership in ICE, EVs, software, AV, and other important technologies for the future of mobility. This underscores my belief that GM will emerge from this transition period even stronger financially and with clear momentum, and that we will be uniquely differentiated from our competitors with the strength of our ICE business, the strength of our EV business, and the progress that I know we're going to be making from a technology perspective. So thanks, everybody. I hope you have a great day and be safe.
Thank you. That concludes today's conference. Thank you for participating. You may disconnect at this time.
You know where your business would be without you. Imagine where it could go with more of you. Well, with Wix, you can create a website with more of your vision, your voice, your expertise. Wix gives you the freedom to truly own your brand and do it on your own with full customization and advanced AI tools that help turn your ideas into reality. Grow your business into your online brand. Because without you, your business is just business as usual. Go to Wix.com.
On WhatsApp, your personal messages stay private between you and whoever you send them to. So things like the passport numbers for your honeymoon stay between you and your fiancé. And that video call for your grand's 80th stays in the family. Even your streaming password stays between you and your college roommates, who still ask for it every week in your group chat. Because on WhatsApp, your personal messages are yours. No one else can see or hear them, not even us. WhatsApp. Message privately.
You know who's surprisingly good with money? Greenlight Kids. The other day, mine stopped to think about the ROI on a bag of chips. Seriously. From getting paid for doing chores around the house to saving up for concerts, Greenlight's teaching my kids how to handle their money.
Greenlight your kids' financial future with the #1 family finance and safety app. Try Greenlight risk-free at greenlight.com/podcast.